Hi, this is Ken Boyd. This is accountinged.com, accelerating your accounting genius. This is my online academy where we have dozens of hours of videos, quizzes, student interactions, podcasts, blogs, all kinds of great information on accounting. And the great thing is you can try it free for 10 days. So I've got that note here at the top, and we add content all the time. So what I'd like to talk about today is an interesting thing. It's spring of 2015. We had a major announcement from McDonald's Corporation, a name everybody knows, and that is a salary increase. So I've titled this course Labor Costs, Profit Margins, and Cash Flow because it's a great way to think like a business manager about how this hourly rate increase would impact your business. So what's happened here is that let's set it up by talking about McDonald's 2013 annual report, which showed a 2% decline in profit margins due in part to higher labor costs. And now you fast forward to spring of 2015, and it says in a press release that company-owned stores are going to increase wages from a current average level of about $9.01 per hour to $10 by 2016. So from 9 to 10 roughly is an 11% increase. So keep in mind that this is only company-owned stores. We're going to see in a minute on a blog that I wrote that the vast majority of stores and employees work at franchisee-owned stores, franchised-owned stores. When you go to McDonald's, it's likely that that store is owned by a franchisee, not by the company itself. So I took a look at the income statement in a very broad brush, strokes very broad. So I noted that payroll and employee benefits were about 17% of sales. Now that's not all hourly income. That includes management compensation, that includes benefits. But just to give you an idea, for every dollar that McDonald's sells, about 17 cents goes toward payroll and employee benefits. And so I estimated that if you increased the hourly rate by $10 and you assume that everybody at the company was on an hourly employee, again, not completely true, but this is just to give you an idea. That's going to increase the percentage of sales that go to payroll from 17% to 19%. And so I'd like to think about, well, where does that take the company? And so I'm jumping over to a blog that I wrote on accounting accidentally called McDonald's, the Impact of Higher Labor Costs. I had a conversation with a franchisee years ago who owned McDonald's franchises, I believe 5, in St. Louis, the town where I am. And he said, I'm not in the food business, I'm in the human resources business. I spend all my time hiring, training, dealing with employee issues and firing. I'm not really in the food business, I'm in the human resources business. So this announcement in specifics was, and this is spring of 2015, that hourly rates for company-owned stores would increase to $10. Now again, there's about 1,500 McDonald's-owned, company-owned restaurants in the U.S. The vast majority are franchise-owned, about 90% of the restaurants and most of the workforce. Now a word on franchises. You can go to page 45 of the 2013 annual report and find out more about that arrangement. Essentially, when you go to McDonald's, the person who probably owns that franchise is a franchisee. They've paid an initial fee to McDonald's, and they pay annual royalties based on a percentage of their sales. So the royalties for the franchisee are an additional expense on the income statement. And it said the agreement typically lasts for 20 years, and then they can be renewed. So now on to the wage pressures. So 2013, they already had pressures for higher labor costs, likely because the economy was getting better, there was more competition for employees, and so if there's more competition, you have to pay more to get the employees you want. There's that 11% labor increase. So I went to the 2013 consolidated income statement, and I found that payroll and employee benefits are about 17% of sales, 17 cents of every dollar. Again, this includes both franchise-owned and company-owned stores. It includes management, but I just wanted to give you a sense of how much of every dollar goes toward paying employees. Now, if the entire line item, the entire expense line item increased by 11%, in McDonald's case, payroll and employee benefits would go from 17% to 19% of sales. It's not a perfect comparison, but my point is that the restaurant would spend 2% more of every sales dollar on employee costs. And this brings up two questions. The first is, how can you maintain your current profit level if 2% more of your revenue is going to go toward paying employees? Seems like you've got to increase revenue 2% on the top line if you're going to take off 2% more in expenses below it. And maybe more importantly, higher costs also affect cash flow. If your costs increase 2%, you need 2% more cash every week to make your payroll, to meet it, and pay it. So the question is, well, where am I going to get 2% more cash? Now with McDonald's, it's not so hard because most people are paying with debit and credit cards and cash. There's not really any receivables in that business for working with day-to-day customers. But still, you got to come up with 2% more cash somewhere. So those are my thoughts on McDonald's. And again, the blog I wrote early April 2015, McDonald's, the impact on higher labor costs. And remember the site where we have a free trial, accountinged.com, dozens of hours of videos. You can try it for free. Thanks very much for watching, and we'll see you.